Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Wednesday, March 4th, 2026, and yeah, the S&P 500 bounced up about 0.8%. But it did not feel like a clean risk-on party. On the surface, the tape tried to price a soft landing. Underneath, it traded like it was bracing for a stagflation shock. The dominant theme, geopolitics and energy, stayed in the driver's seat right up until oil stopped accelerating and the market grabbed a quick relief bid. On the S&P 500 heatmap, it was green, but very selective. Consumer discretionary lit up. Amazon and Tesla were the bright anchors. Semis were firm too, with intense greens in AMD and Micron. But energy was the obvious red pocket. Exxon and Chevron faded as the oil spike cooled. And defensives? They didn't feel safe. Staples showed clear red, and healthcare ran mixed to soft at the top. So what explains that heat map? Money flow. As crude cooled, capital rotated out of the inflation and geopolitics hedge complex, energy, and back into duration-sensitive growth and high-beta discretionary. This was not a buy-everything day. Traders crowded into the most liquid risk proxies, mega-cap growth, and into the most narrative-heavy pocket, semiconductors, and importantly, small caps joined in. The Russell 2000 popped about 1.1%, a sign that risk appetite broadened beyond just the biggest names. Now the tension behind the move. Overnight, we got a visceral global shock. South Korea's CAPSP plunged about 12%, its worst day on record. That panic spilled into the U.S. Open, with the Dow down more than 1,200 points early. The turn came midday, off two levers. Brent crude cooled from an $84 peak, and the ADP report showed roughly 63,000 private sector jobs. But here's the tell: rates didn't celebrate. The 10-year yield held above 4.08%, so stocks bounced, but the bond market did not buy the easy policy story. On the chatter side, this is where you separate price from narrative. There was talk that so-called smart money kept moving into safe haven US dollar and gold, even as equities bounced, basically hedging the relief rally. At the same time, crypto-friendly policy chatter made the rounds, with regulation optimism floated as a tailwind for crypto proxies. None of that is a confirmed driver on its own, but it helps explain why today felt more like catching a breath than declaring victory. While most of the market focused on geopolitical shocks and rising volatility, a strange sanctuary showed up. In one session, old world finance and the new world of digital assets suddenly moved in opposite directions. Bitcoin ripped more than 7%, back above $73,000. At the same time, Coinbase jumped nearly 15%, one of the top performers in the S&P 500, signaling a powerful wave of capital flowing back into crypto infrastructure. And this wasn't just a random speculative bounce. Two big catalysts flipped the story. First, President Trump held a private meeting with Coinbase CEO Brian Armstrong and signaled support for the Clarity Act, legislation meant to finally lay down federal rules for digital assets. Markets read that as a step toward long-awaited regulatory certainty. Second, Kraken's banking arm reportedly secured a Federal Reserve master account, giving a crypto-native institution direct access to the Fed's payment system, something the industry has chased for years. The divergence is the real story. Normally, when geopolitical risk spikes, investors hide in gold or government bonds. This time, traders rotated capital out of traditional cyclicals and into digital assets. That shift hints at something bigger. The market is starting to treat blockchain not just as speculative tech, but as the backbone of a parallel financial system. So the question now isn't just where the charts go next, it's whether regulation is about to redefine the entire crypto market. If you want to see how fragile this global rally really is, look at what just happened in Seoul. While most of the Western world slept, South Korea's KOSP index plunged more than 12% in a single session, one of the worst crashes in its history. Panic selling hit circuit breakers as hundreds of stocks collapsed at once, forcing trading halts across the exchange. On the ground in Pangyo, Korea's Silicon Valley, workers reportedly crowded around their phones, trying to unload positions as the market spiraled. But this is not just a Korean story. It's a global supply chain story. South Korea sits at the center of the semiconductor ecosystem. Samsung Electronics and SK Hynix, pillars of the global AI chip supply chain, sold off sharply, sending shockwaves through tech and export sectors. The trigger: energy risk and geopolitics. South Korea imports roughly 70% of its oil from the Middle East, so any threat to shipping through the Strait of Hormuz hits fast. Then came the real warning. The Korean won slid past 1,500 per dollar for the first time in 17 years, a classic sign of capital fleeing risk. Today, Seoul looked like the outlier, but when leverage starts unwinding in one of the world's most export-sensitive economies, it rarely stays contained. Watch the one and watch the chip makers, because the markets that move first are often the ones telling the truth. Amazon was one of the cleanest tells in today's rebound, up about 3.9%. On a day when traders wanted liquid, instant beta, Amazon acted like an all-clear button. Commentary flagged it, breaking through key technical resistance and reclaiming momentum after the sell-off. When this stock is strong on a fragile day, it can make the whole tape feel more stable, at least for a trade. Tesla was another high-signal move, up about 3.4%. This was a high-beta rebound day, and Tesla tends to be the risk thermometer for both retail and institutions. The narrative leaned on its energy business and the FSD regulatory path as support for dip buying. When Tesla's green in a relief rally, it usually means risk tolerance is rising across momentum baskets. In semiconductors, AMD was pure torque, up about 5.8%. That matched the Heatmap. Semis were a standout green pocket as the market re-risked. Reports pointed to product buzz around the Ryzen AI 400 and Pro 400 launches at Mobile World Congress 2026 as the catalyst. On days like this, AMD's strength reads as a broader risk appetite tell for the AI hardware complex. Micron added to the semiconductor breadth story, up about 5.6%. The key point: this wasn't just one flagship name. Micron ripped alongside AMD, reinforcing that the semi-pocket was broadly bid. And to stay disciplined, there wasn't a specific same-day Micron headline in the sources. This looked like sector-level positioning driving the rebound. Exxon sat on the other side of today's rotation, down about 1.3%. Energy lagged as oil stopped spiking, and that underperformance became a key narrative pivot in the session. It doesn't mean the geopolitical risk is gone. It just shows how quickly the market will fade the immediate inflation impulse when crude cools, even as equities bounce. Broadcom was the setup stock. AVGO had fiscal first quarter 2026 earnings after the close. Broadcom is a crucial AI infrastructure bellwether, so the after-hours reaction can matter for the entire semiconductor and AI complex into the next open. This is one of those prints that can either validate today's semi-strength or force a fast rethink tomorrow morning. Looking ahead, the highest velocity catalyst is still geopolitics through the oil channel, so watch crude overnight. Second, watch the post-earnings move in Broadcom because it can reset sentiment across semis and the broader AI complex at the next open. And on the calendar, the next big macro catalysts are CPI on Wednesday, March 11th, claims on Thursday, March 12th, then a heavy Friday slate. Core PCE, GDP, durable goods, JOLTS, and University of Michigan sentiment. No forecasts here, just the map of what can move this tape next. So the takeaway: the market bounced, but it did not get closure. The rebound was real, led by mega-cap discretionary and semis, but it was selective, and it sat on top of unresolved geopolitical and energy risk. Watch two key tells into the next session: crude staying contained, and whether semis hold up after Broadcom's print. If those wobble, this can flip back fast. If they don't, the dip buyer playbook stays in motion. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.